Welcome in everyone to the third session of the Managing Cow-Calf Operations for Profit Conference. Tonight's session is Valuing Breeding Stock, Tax Management Strategies, and Optimizing Stocking Rates. My name is Becky Thompson, and I'm the director of the Kentucky Beef Network. While we are disappointed that we're not together in person this evening, we are excited to bring you some great information from our speakers. Tonight's program comes to you through funding from the Kentucky Agriculture Development Fund, in part by the Kentucky Beef Network and the University of Kentucky Department of Agriculture Economics. We are recording tonight's presentations, and we will be sharing the video links and the slides at the conclusion of the series. Before we get started, I would like to touch on a few Zoom housekeeping tips. You may submit your comments in the chat box below at any time. Simply click chat, type your comment, and hit enter to submit the comment. If you have questions for our presenters, we ask that you place those in the Q&A window, allowing you to ask questions to the host and panelists. They can either reply back to you through the Q&A window, or they can answer your questions live. At this time, I would like to turn it over to our speakers, Kenny, Greg, and Jonathan. Thank you.
Well, thanks a bunch, Becky. I guess I'm the lead off tonight, so I know I speak for us all when I say we're glad that you're on for night 3 and hope you've gotten a lot out of the first 2 nights. Like she said, we were crushed to have to cancel these. We did 5 out of 12 we had planned back in 2020 and thought we could get back face to face sooner than we can. So we formatted these for a virtual delivery, and that's kind of what we've been doing the last 3 nights. So this is the third night of that of those profitability conferences that we started back in the winter of 2020. So the topic I'm going to cover here for the next 30 minutes or so is going to be focused on breeding stock depreciation. And we're going to really focus on how that impacts my return as a cow-calf operator, and really kind of talk a little, really kind of answer the question, what can I really afford to pay for a bred heifer? Or what can I afford to spend when I develop my own bred heifers? If I were going to summarize this particular discussion in one sentence, it would be the opening bullet there would be that as a cow-calf operator, you need to take a long-term view on long-term investments. Cow-calf operations do exist annually, and in some ways we manage them annually, but each one of our breeding stock is a multi-year investment, 6, 8, 10 years. So the profitability of those breeding stock is not determined in a single year. It's determined over their lifetime. And I think that's kind of the umbrella behind what we're going to be talking about here for the next little bit. Now, when producers think about breeding stock, they typically think about things like equipment. They think about things like facilities, but it applies to breeding stock too. And that's really where we're going. Cow-calf operations and all of agriculture are unique in the sense that profit tends to capitalize into the asset value. And by that, I mean, when we've got high calf prices, when we've got profitability overall in the cow-calf sector, that tends to get reflected back in high breeding stock values, particularly bred heifer values. And think about the case of 2014 and 15, when our average price for bred heifers and our bred heifer sales in the fall of 2014, and really fall of 2015, was between $2,400 and $2,800. And those of you that are on the webinar probably know that while that may have been the average range, we had a lot of those bred heifers that sold for north of $3,000. The only way that kind of money could have been justified for breeding stock would be if the calf market stayed at the level that it was at for, basically forever. So in other words, we bid on those bred heifers as though the calf market was going to stay where it was over the next 5 or 10 years. So think about an extreme example, someone who bought a cow herd or bought a bunch of heifers in a year like that, and how that would impact their cost structure. That's kind of the extreme example. For most operations, those expensive bred heifers are a percentage or a small share of their overall cow herd. Now, when we run cow-calf budgets and estimates, and we talked opening night, the very first presentation, we walked through kind of an estimated cost and return scenario for a cow-calf operation. We usually land somewhere in the ballpark of $350 to $450 for what we kind of think of as feed and cash cost. You've also got a lot of variation across fixed costs, buildings, machinery, fencing. Greg talked about some of that on opening night. And then Jonathan and Greg both focused more on hay costs and machinery related stuff in the second presentation on night number one. Now, I'm just going to jump right into this. We're going to really be talking about a spreadsheet decision aid that Greg and Samantha Kindred and myself put together back in 2015. And this is just really a snapshot from that decision aid. But we're going to be kind of talking about specified cost in a format like this here for the next little bit. Now, I do want to make a bit of a distinction. And one thing I said that we've really tried to do, the three of us, is we really tried to make these presentations link together. And one thing I do want to point out, when on opening night, when Greg talked through that, that cow-calf cost and return scenario, he really looked at hay cost in the beginning as more kind of those cash type costs. And then he dealt with the interest and depreciation on that, later in terms of the depreciation that he discussed. So that was outside of those specified cost. For the scenario that I'm going to run through right now, I've got pasture maintenance at $25 an acre. I'm assuming 2 acres per cow or per animal. I've got 2.5 tons of hay at $75 a ton. I'm not going to include pasture rent. I'm not going to include labor. I've got $24 for mineral, $20 for vet and medicine, $40 for breeding, $35 for marketing, $20 for machinery. And again, I'm trying to include hay machinery here and pasture clipping here. So I understand that this really is kind of machinery for mostly hay feeding. I've got trucking at $10 a head, and then I've got another category at $13. So once you kind of know what I'm showing you here, but it's purposely calibrated to be $400. All right, so that's kind of where we're going to start from baseline, and we'll talk about how that's going to affect our profitability as I have higher or lower cost structure than that. Now, very often a producer would do something like I just showed you, and they would compare that $400 cost to what their average calf sell for, or what their revenue per cow. And one of the most commonly made mistakes when someone looks at or tries to analyze the profitability of a cow-calf operation is that they don't account for breeding stock depreciation. And just like any other asset on the farm, breeding stock is going to be worth less at the end of its productive life than it was when you first placed it into service. So a very simple illustration, if I want to think about a way to look at breeding stock depreciation on an annual basis, I apologize. I can take bred heifer value. So think, simple form, think what I paid for a bred heifer when she entered the herd. I can subtract what I think she'll be worth as a cull cow at the end of her productive life, 6, 8, 10 years from when I placed her in service. And I can divide that by a number of productive years. So again, simple illustration. If bred heifers are selling for $1,500, this is a low this is a low cull cow number, but keep the math simple. If bred heifers are selling for $1,500, and if I expect her to be worth $500 as a cull cow, and I expect an 8-year productive life on her, 1,500 minus 500, she depreciates $1,000 over her lifetime. Over the course of 8 years, she depreciates $125 a year. Now, I do want to stop and make a distinction here because it's very important. This is a simple approach to estimating economic depreciation. And one point that Greg made on the very first, I guess is, it'd be the second presentation, first out of these programs, was don't confuse economic depreciation with tax depreciation. So some of you sitting out there might be saying, well, I've got to depreciate heifers over 5 years or something like that. And I understand for tax purposes you do. What we're really trying to do is come close to really thinking about, okay, how much does the value of that breeding stock go down over time as they're in service longer? And that approach that I showed you is kind of a simple straight line way to do that by just looking at how much her value goes down over the course of some number of productive years. Now, in addition to that breeding stock depreciating, there's also an opportunity cost, or it could be an actual cash cost, when I think about how much money I've got tied up in that breeding stock. So, simple example, if I assume that my cow herd is made up of cows of all ages, some first-time calvers and some that are 8, 10, 12 years old, then we can kind of assume that the average value of a cow in my herd is something like the midpoint of these two numbers. So in this case, $1,000. And then I've got to think about what a reasonable interest rate is to charge on that. Now, if my cows are truly financed, then that's pretty straightforward, right? In a lot of cases, they're not. And this can be thought of as an opportunity cost, meaning, if I've got $1,000 tied up on, 50 cows, that's $50,000 I could have doing something for me. So understand the concept more so than the number. But we're going to use 3% as just a way to value the opportunity cost and the interest, if you will, on the value of those breeding stock in the herd. Now, a very legitimate question that you could ask would be, well, what if I don't buy heifers? What if I develop my own? And by the way, most cow-to-calf operators do that very thing. Understand that that's really not going to change the analysis that much. I have people tell me sometimes, they'll say, Kenny, I can develop my own heifers for $450 a head. And they may in fact be right, okay? But they're also ignoring the first and the most important cost they've got when they hold back a heifer. And that's what I don't get for her when I don't sell her at weaning time. So that's cost number one. So if those heifers are worth $700 in the fall, and I'm going to keep her to breed her, I've got to keep her 12 months. I've got to get her through a winter, and I've got to get her through another grazing season and get her bred so that she's comparable to a bred heifer, okay, the following fall. So oftentimes they're looking at these costs and probably just cash cost, and they're ignoring the cost in terms of the value of what they're not getting for that heifer at weaning time. And even then, it's not apples to apples. And you know, so kind of a simple illustration, if I buy a bred heifer, she is bred, right? If I develop my own heifers, they're not all going to breed. So it's still not apples to apples, but it's a little bit closer to think about it that way. The way I like to think about it is really twofold, okay? Number one, if I can in fact develop heifers cheaper than I could buy them for in the marketplace, and what that really means is that their cost going in, their basis, if you will, is lower, which means I'm going to have lower depreciation on those heifers, meaning I'm going to have more profit per year because I've got a little bit less tied up in them. Another way to think about it is, well, I could value my heifers at market value, and I could say, well, if I can do it for $150 less than that, then I've made $150 per heifer on a sideline heifer development enterprise. So however you look at it is fine, but it doesn't change the analysis that much. Now, what I'm really going to do here for the rest of this presentation is I'm really going to walk you through some results and talk with you about what they mean from this tool that I referenced earlier that Greg and myself and Samantha KINDRED put together in 2015. I've got the URL for it there at the bottom of the screen, and we can drop that in the chat here as well. But what I want you to understand is we put this together in 2015 for a very key reason. We frankly were just shocked at the value of what some of these bred heifers were going for in these sales. So we wanted a tool that would allow folks to really make kind of an estimation of how a given price they might pay for a bred heifer would impact their profitability if they consider more of a long run average calf price. And again, we've said it many times throughout the course of this last 3 evenings is that we're trying to focus everything on what we think is a realistic average long run calf market. And that's the way you want to look at an investment like breeding stock that's going to be a 6, 8, 10-year investment. Now, here's some screenshots from that very tool. At the top, when you open it up, you'll be asked some basic questions. Well, what are you going to pay for the bred heifer? How many productive years do you think she'll have? What's your expected weaning rate, meaning what's the probability that she weans you a calf? We've got a death loss probability, if you will. So this is ultimately going to discount the cull cow value for the fact that you're not going to get all your cull cows sold. Some are definitely going to lose some. And then that interest number that I mentioned, 3%, you can drop that in there too. You've actually got the option of entering those cow maintenance costs directly, or you can choose an enter below option, and it'll bring up the very table that I showed you earlier. And you can actually enter those one by one, and it'll figure those costs for you as you do that on a piecemeal basis. On the right side, this is more the calf related stuff. This is where you're really going to enter what you think is going to be the long run revenue stream for these calves. So what you expect from weaning weight on both your steers and heifers, and what you expect that long run average calf price to be. It's going to bring everything else in so that you can look at your expected revenue, you can look at those costs, it'll figure that breeding stock depreciation, it'll figure that interest, and it's gonna return you a gross return per cow per year above those things. Now, this number itself is useful and it's important, but the most valuable piece of the tool is it's also going to generate this in table format. And Greg and Jonathan, we really ought to go back and figure how many tables like this we've shown over the course of the last 3 nights. I suspect we're in triple digits now. But we like to show things this way because we want you to understand that so often the answers to economic questions are not a single number, okay? It's a range of estimates based on some assumptions. And we like to kind of see, we like you to kind of see some variation, you know, how does, in this case, how does that long run average calf price and how does your cost per cow affect that gross return? So this table is really, I think, the most important output that you'll get from using that tool. Now, I want to talk about some things that are not going to be included in what I'm about to show you. Remember something that we said early on. We said, you know, the return at the bottom is always to things you didn't specify as cost. So what I'm about to show you, I'm not going to include labor. And I'm also not going to include any charge for land. Now, I can back up a couple slides and I can show you, going too far, I'm sorry. I can show you that I could in fact specify pasture rent if I wanted to. I could in fact specify labor if I wanted to. I just simply didn't in this case. So what I'm going to show you is going to have to be a return to land and labor. Also don't have other capital items in there besides what we talked about tied up in the hay, in the pasture clipping, and then what little bit I've got in there for hay feeding. So it's a little bit like that gross return from opening night if I think about a return to land and labor, and then frankly, still some depreciation interest that's not specified. So when we talk through these numbers, understand what that return actually is too. Now we're going to walk through a run of this, and these are the things that are going to stay the same. And this has been pretty consistent how we've talked about things over the last 3 nights, but we're going to assume an 85% weaning rate, which we think is probably about an average weaning weight for a cow, weaning rate for a cow-calf operation. We're going to use a 550-pound weaning weight, and we're going to assume that for a steer heifer average. I'm going to use a $600 cull cow value. So think about a 1,200-pound cow at 50 cents a pound. I wrestled with that. I thought about going to 650. You know, the market's going to move on that. If you throw out 2014 and 2015, honestly, 50 cents is not that far from a long run average cull cow price, especially in the fall of the year. So I went with $600. I'm going to discount this, as I mentioned earlier, by 5% for death loss. And really the way you want to think about this is basically going to assume that you're going to actually get a cull cow value from 95% of the cows that you manage. So we're just going to discount that by 5% for the few that you might lose and not be able to sell as culls. And then I'm going to assume 8 productive years, which means we're going to assume that I can get 8 calves over the productive life of one of these bred heifers that I enter into the herd. Now, don't gloss over that number. And in fact, on opening night, someone asked the question, you know, what is the expected useful life of a bred heifer? And it's a good question. And there's not a super good answer to it. It varies a bit, of course. And what really matters is what do you expect when you put that heifer in service? I shared this story on opening night when the question came up. You know, I said, I have people tell me all the time, they've got cows that are 12, 14, 15 years old, right? And they say, so I know I've got a high productive life than 8 years. But you also have to think about, okay, how many of them didn't make it to 8, right? A lot of our cows, you know, don't breed back, you know, a few years in, they get cold for some reason. You kind of got to think averages. And the way you want to think about this is when you truly place a heifer into service, you know, how many calves do I really expect to get out from her over her productive life? I don't think 8's that bad a number. I think anywhere between 6 and 10 is probably reasonable. Personally, I think if anything, 8's a little high. That's just my bias. I'm going to work off of 8 going forward. We're also going to let 3 important factors change in what I'm about to show you. So again, we've talked a lot about what we think might be a reasonable long run average calf price. And we want to talk, you know, we have talked the first 2 nights and we'll talk tonight about trying to help you maybe be profitable in a $1.50 calf market. So we're going to talk about a long run steer heifer average calf price at 550 pounds of $1.50. We're going to show you 20 cents less than that at $1.30 and 20 cents more than that at $1.70. And we're going to look at how that impacts profitability given what I might pay for bred heifers. I'm going to center the bred heifer cost at $1,300, but I'm going to show bred heifers as cheap as $1,100 and as high as $1,500. And I'm going to show you how that impacts profitability over time as we think about how that affects depreciation and interest cost on these operations. And then I showed you earlier, we're going to kind of center those cow maintenance costs we talked about, which mostly cash and feed costs at $400. And we're going to let them go down by 100 and up by 100. So we can talk about how returns are affected by annual cash cow maintenance cost. So what I'm going to do, I'm just going to kind of start filling in another table here for you. This is going to be based on a 550 pound steer heifer average weaning weight and a $1.50 calf market for the two. So understand what this means. This probably means a $1.60 steer and a $1.40 heifer, something in that ballpark, okay? And we're going to let cow maintenance vary here on the left cost, and we're going to let bred heifer cost move across the top. And again, understand this is a gross return. This is a return to management and a risk. There's no charge for labor in here. So this number's got to be, in my opinion, 200, 250 to make it reasonably attractive. So our base case, a $1,300 bred heifer and $400 cow maintenance cost, I've got a gross return here of $182 per cow per year. Now that may look fairly attractive. Understand I've not charged for land, that I've not charged for labor, and there's even still some overhead costs that are not included here. So that's kind of where I come down and need at least $200, maybe closer to $250, $300 to make this really attractive. So our base case, I've got a gross return of $182 on a $1,300 bred heifer, using a long run average calf price of $1.50. Now, if my cost structure is lower, and we've talked about some things, you'll hear some more here tonight, but if my costs are $50 lower, obviously, then I'm going to add $50 to my bottom line there. Okay, so that return, that gross return goes from 182 to 132. If I'm less efficient, I'm sorry, it goes from 182 to 232. If I'm less efficient, if my costs are 450 instead of 400, and I've subtracted 50 bucks off that bottom line, and that gross return goes from 182 to 132, then I can fill the box out. I guess the point that I want to make is if your target is to have a $200 return to land and labor, which I think is very reasonable, on a $1,300 bred heifer and a $1.50 calf market, your cost structure has got to be less than 400 bucks a cow. And that's going to be tough to actually get there, specifying cost as we did here. Now, the way that the price, the value of breeding stock impacts our bottom lines is it simply increases the depreciation and interest cost on that breeding stock. Okay, so by going to a $1,400 bred heifer, what I've really done, I've subtracted $14 from each one of these boxes in the middle. Okay, so my cost go up by roughly 14 bucks a year for every $100 more that I spend on a bred heifer, whether she be one that I buy or one that I developed. Similarly, if I can get the same heifer, same quality heifer bought cheaper, or if I can do it less myself, for every $100 less that I spend on that bred heifer, I've added $14 in each one of those boxes. I can fill the rest of the chart out. So I guess what I want you to do when you kind of take this home with you is this is kind of our base run. Okay, this is a $1,300 bred heifer. This is kind of gauged for a spring calving herd. It's a $1.50 long run average calf market. And again, if you buy into what I'm saying, that to make this attractive, you probably need to see this number 250 or so at least, and you can kind of get an idea where we've got to be. It's hard to get there to impossible if I've got cost over 400 bucks. And folks, it's even challenging, right? If I've got cost at 400. So cost make a big difference, as does what I spend on those bred heifers. Now, this won't look near as attractive, but I want us to look at the same thing for a $1.30 calf market. In other words, if you think our estimate for long run average calf price is too high at $1.50, here's a $1.30. And no surprises, won't look near as attractive. Remember, in the base case, the $1,300 bred heifer and the $400 cow maintenance cost, that gross return to land and labor was $182. Folks, it drops by almost $100 when I drop that calf price by 20 cents. So that gross return goes to $88. I can fill that line out. Folks, at $1.30 long run average calf price, I can't get to a $200 gross return to land and labor. I can't get there. I can obviously fill the rest of these out, and just kind of looking at these boxes, if $1.30 is our long run average calf price, I've either got to have an extremely low cost structure, which I think is going to be difficult to impossible, or I simply cannot give this kind of money for bred heifers. Or another way to say it, I can't spend that amount of money developing bred heifers myself and expect to do well on them. Understand how that matters. Now, finally, we want to show you the exact same thing for a $1.70 market. I probably should have said this earlier, but there's a reason why we chose to use $1.50, $1.30, and $1.70. We really do think $1.50 is a decent gauge for what long run average price will be. $1.30 in our opinion. So I think this probably means something like, I don't know, $1.40 steers, $1.20 heifers, or 35.25, something like that. We feel like at that point, profits are low enough that we start to see liquidation and we don't spend a lot of time at prices lower than that. And then here's the other extreme. We think once we get above $1.70, which again, this is probably $1.80 steer and $1.60 heifer, we feel like at that point, if that's our fall calf price, then we're going to start seeing expansion, and we're not going to spend a lot of time north of that. So that's kind of how we set these long run average calf prices for the analysis. But again, in the base case of $1.50, we were at $182 gross return. If that long run average calf price were 20 cents higher, if it were $1.70, that gross return is $2.75. At this point, we're obviously getting pretty close to making this look pretty attractive and covering certainly land, labor, and a bit more on top of that. I can fill that box out, of course, and I'm just adding and subtracting the difference in cost. I can fill the others out, and as you can see, if my target here were 2 or 250, okay, I can get there in a lot more scenarios, but I will make the point again that if I'm an extremely high cost producer, meaning if my costs are $500, okay, I can barely get to $200 on the $1,100 red heifer. And folks, frankly, if the long run average calf price were $1.70, we're not going to see $1,100 heifers. Okay, so it really speaks to, I think, be careful with different bred heifers, and then certainly managing our cost. More so than the numbers, I think it's good to talk about how changes impact those numbers. The cost reductions are direct, right? For every $25 I can shave off of my cost, then I'm going to add $25 in each one of those boxes. That one's straightforward. I showed you a 20-cent change in calf price, but based on weaning rate, 10-cent change in calf price. If calf price goes up by 10 cents a pound, I'm going to add $40 to $50 each one of those boxes. If it goes down by 10 cents, I'm going to subtract $40 to $50 each one of those boxes. We've mentioned weaning rate maybe 4 or 5 times already. This may be the last time that we mention it. I think it will be actually, but a 5% increase in weaning rate, meaning if I can go from the 85% base that we assumed and go to 90%, then I can add $35 to $40 each one of those boxes. And that makes a big difference. So think about the extremes. If you're weaning 75, 80% calf crops, and you can bump that up by 10%, which is possible if that's where you are, you're talking something like 70 to 80 bucks that you could add in each one of those boxes. We talked about weaning weight some last night in my discussion, but 50 additional pounds of weaning weight worth between $30 and $50 in each one of those boxes. But remember, that's gross. And I mentioned this earlier, every additional $100 that I spend on a bred heifer or spend developing a bred heifer adds about $14 per year to my cost structure when I consider depreciation and interest. So if you're looking at more expensive bred heifers, you want to ask yourself, okay, can she generate me more revenue, right, above cost to offset an additional $14 or so for every additional $100 that I spend on her? So this discussion was really meant to focus on breeding stock and breeding stock investments and how that impacts our bottom line. But it's also hard not to start here and just say you can't overemphasize cost control. And I really do think that's key, is understand that the single most important factor on that bottom line, besides maybe calf price, was absolutely what those cow maintenance costs were per year. Do understand, though, that breeding stock depreciation really impacts cost structure. And if I can leave you with the one thing, I'm going to say what I started with. Understand that profit is determined over the course of a cow's productive life, not a single year. So don't get wrapped up in current calf prices when you think about what you can spend on breeding stock. Think about long run. What matters is not the current year. What matters is the next 6, 8, 10 years. Take a long-term view on long-term investments. And we really think that this bred heifer profit estimator will be a good way to help you do that. I will leave you with my contact info. Again, I'll obviously be on for the rest of the night. We can talk more if we need to. Be glad to answer some questions. If you do have questions or stuff you want to talk about individually, one-on-one, either reach me on the phone, by email, or follow me on Twitter at KY Cattle Econ.
Great, Kenny. We do have a few questions. This first question is about cow age. So you may want to reference back to our beef extension specialist, but I'll ask anyway. Do cows age 12 and above normally have slower growing calves or take longer to breed?
Well, so Becky, yeah, so Becky's right. I would refer you to one of our animal scientists on that. I can tell you though, from the BIF data that I looked at years ago, and I worked on this, I worked on a project where we tried to do kind of what you're talking about and try to look at, okay, how is a cow's productivity affected? She would begin weaning smaller calves. And then by the time she got to, I want to say her fourth or fifth calf, she kind of reached a bit of a peak. And then she held that for a pretty long period of time. It was, I think it was after maybe 10 years of age or so when that started to come down. So that was kind of the productive cycle, if you will, of that cow's life. So check my memory by talking to one of our animal science folks. But yeah, I think the peak was around year 4 or 5, and it held pretty steady past about year 10.
Okay. The next question is to confirm cow age, Kenny. You're discussing is age from birth or age from breeding season?
That's a good question. I didn't notice who asked that, but Steve, yeah. So my apologies for not being clear, Steve. But yeah, I'm referring to productive years. So when I say 8 productive years, I really mean 8 calves. Not a cow that's 8 years old, but one I expect to get 8 calves from. Thanks for that question.
The next question is referencing back to the assumptions on your analysis slide. How do you account for cull cows that go to market prior to 8 years, i.e. cows that don't breed back, bad feet, or something that can't be fixed on the animal's body?
Yeah, so that was one of the things I guess I was trying to make the point about when you think about what that productive life is going to be. And remember, you're looking forward, right? So I've got a bred heifer that's entering my herd today, or I'm thinking about buying a bred heifer, for example. Okay. The question is, how many productive years do I expect to get out of her? Right. So the truth of the matter is, yeah, I have a history of some cows that are 10, 12 years old or more, right? But I also have that same history you're talking about where I've had to let some go at 5 or 6 years old due to feed or something. So you got to think about both of those things about, okay, what's a realistic expectation? Now, doing a good job getting heifers bought or choosing the right kind of heifers to develop, then that may actually impact that useful life, because if you can identify those potential problems and avoid them, then you may get more life out of those heifers over their lifetime.
Okay, Kenny, this is the last question we have for you right now. I do want to remind all of our attendees, Kenny will be with us the rest of the evening. So if you have other follow-up questions, we'll be happy to address those at the end of the program. So the last question is, how have the cost share programs in Kentucky driven up the cost of heifers?
Yeah, the question is how have they? So I agree with the premise of the question. I do think there's an impact there, right? You can get, in most counties, you can get cost share on bulls and heifers. And, the way most producers look at that is, what am I actually out of pocket for the heifer or the bull, right? So there's no question that does make them bid a bit more aggressively. And I think it absolutely affects what those bred heifers sell for. And I would say the same thing about bulls as well.
Great. Kenny, thank you. That's all of the questions right now. Jonathan Shepard is next on the program. Jonathan, when you're ready.
Okay, just everybody can see my slide deck. Okay, correct?
It looks good and we can hear you.
Excellent. All right, so a little bit of a change of topical direction here. Instead of focusing on some of the things we had before, I'm actually going to take you down a different road, and we're going to talk a little bit of tax management and hopefully show you some strategies, talk through some issues, and give you some tools to help you manage some of your tax situations. So a lot of this comes, as I told you before, my previous line of work with the Kentucky Farm Business Management Program and working with taxes. And there's just some things that I have noticed that sometimes farmers overlook. And so just kind of want to address those issues with you all so that you're aware that these things exist and maybe they will be of benefit to you and your operation. So the first thing I'm going to start with is talking about ordinary versus capital gains under the context of depreciation recapture. So what I've heard a lot is somebody will sell a tractor or something like that, or a piece of equipment, some asset that they've set up on their depreciation schedule. and they will say, well, I sold this tractor this year. I have to pay capital gains on that. And that's almost always incorrect. You're probably going to pay ordinary income tax on that because you had that item set up on depreciation. So to see this, I think it's a little bit easier to work through an example. But just know that if any time that you dispose of an asset that had previously provided you to depreciation expense, which was an offset to ordinary income whenever you took that depreciation expense, that you're going to have a Section 1231 or capital gain possibly, but in most cases it's going to be a Section 1245 gain, which is once again ordinary income. And when we work through this example here, you'll see why that matters. And it all comes down to tax rates and at what rate you're going to pay taxes. So let's assume that we've purchased a tractor in 2010 for $50,000. The way this example is set up, we're looking at it from the 2019 year, but by 2018, that tractor has fully depreciated. So let me pause here just for a moment and tell you that it's okay for you to start thinking about depreciation in terms of taxes. Up until this point, we have reminded you that we were talking about real depreciation or economic depreciation, that we were not talking about tax depreciation. For this presentation and this presentation only, you can take off that economic depreciation hat and put on your tax depreciation hat, because here we are actually talking about depreciation as defined by the Internal Revenue Service. So back to the example, $50,000 tractor in 2010, it would be fully depreciated out by 2018. Assume that we sold that tractor in 2019 for $30,000. We actually have to recapture that depreciation, which is going to be equal to the sales price of $30,000. The good news is that this is ordinary income, but it's not subject to self-employment tax. And why is that important? Well, you can see the red text there on the slide. It's a 15.3% savings, right? So anytime that we can exclude something from self-employment tax, it typically is in our interest to do so. That being said, I always just like to throw up the tax brackets for everybody as well, just to kind of remind us, a rough idea of where the tax brackets in the U.S. sit. So I just pulled this off the taxfoundation.org website. You've got your three categories there: single, married, filing joint, head of household. I also like to remind people that we have a progressive tax system here in the U.S. And it's also important to point out, I think, that as you'll hear people say, I'm in a certain tax bracket, they'll say, well, I'm going to fall into the 22% or the 24% tax bracket this year. Just note that if you're in this 24% tax bracket, married, filing joint, let's say you're fortunate enough to have an income of $326,600 between you and your spouse, you don't just take that $326,600 and multiply it by 24%, right? You're only paying 10% on the amount up to $19,750. Then you're only paying 12% on the amount over that 10% bracket, so on and so forth. Just like to point that out. Sometimes that's a point of confusion too with the tax system, just the way in which we say things. Sometimes you'll hear people say that, I'm in this tax bracket, and what they're meaning is that's really their marginal tax bracket. That's the percentage that they're paying on those last dollars earned, so to speak. Let's circle back around here to our depreciation example. In this case now, this $50,000 tractor that we purchased in 2010 that's fully depreciated is now going to be sold for $55,000. So we're actually going to sell it for $5,000 more than what we bought it for. We still have an ordinary gain situation, or a Section 1245 gain. So that $50,000 that we depreciated originally, that was associated with the original purchase price of the tractor, is going to be recaptured as ordinary income. The $5,000 in excess of what we paid for that item is what we get to treat as a capital gain. So the $50,000, once again, same as it was when we sold it for $30,000. It's going to be ordinary income, but now because we sold that asset for more than we paid for it, we have a $5,000 capital gain. It gets even more complicated than that whenever you're dealing with capital gains and trying to figure out exactly how much tax you're actually going to pay on some event that triggers a capital gain. And this goes back to the idea of Section 1231 losses and recapturing those losses. So if there had been 1231 losses in previous years, we got to count those 1231 losses as they occurred as offsets to ordinary income. And so when we have a capital gain, we've actually got to go back and recapture those 1231 losses over the previous 5 years as well. So a portion or all of your 1231 gain that you have in any particular year could actually turn around to be treated as ordinary income to offset those previous 1231 losses that you had in the years before. So same example here. We're still dealing with this $50,000 tractor purchased in 2010, selling it for for $55,000 in 2019. And then just assume that at this particular farmer, they had this previous Section 1231 gain or loss scenario. So in 2014, they had neither a 1231 gain or loss. 2015, they had neither a 1231 gain or loss. In 2016, they had a negative $2,500, the proper way to say that is a $2,500 1231 loss. And what could trigger that? Selling a piece of equipment could trigger that, depending on the specifics. But somebody could have just had some investments or something that they sold and ended up having a capital loss associated with that. 2017, no activity there on the 1231 side. And then in 2018, they actually had a 1231 gain. So what has to happen is we have to actually go back and sum up those 1231 gains or losses over that previous 5-year period. Now, I'm showing you another table and kind of got everything jammed up here. So I've highlighted that we're looking at this 2019 1231 gain of $5,000 separately. And what I've got highlighted here is what we're netting together to arrive at what our quote 5-year net 1231 situation is. So if we take the loss in 16, the gain in 17, net those together, we end up with we end up with a negative $1,800. In that netting process, we apply that to that $5,000 capital gain in 2019, and that gives us $1,800 of that $5,000 of that tractor that we sold that we thought we were going to treat as a capital gain actually as ordinary income. But the difference, the $3,200, we do actually get to count as a long-term capital gain. So once again, this $3,200 will be taxed at the capital gain rate, and this $1,800 will be treated taxed at the ordinary income rate. Why is this? I've already alluded to this, but let's talk about it more specifically. The rationale behind this 1231 loss recapture is that when that 1231 loss occurred in the previous 5 years, it was treated as an offset to ordinary income. So if you have had a 1231 loss in the previous 5 years, your ordinary income was reduced by the amount of that loss. So the IRS says that you have to go back and recapture that when you have a 1231 gain. It is actually one of the few areas of the tax code that I think makes total sense, and it's kind of the best of the both worlds type scenario. So in those years that you had a 1231 loss for whatever reason, you got to actually count that off immediately against your ordinary income. But when you have that 1231 gain, then you have to go back and recapture those losses. Anything beyond 5 years doesn't matter. So if you were looking at this from the current tax year for 2020, even though in 2021, our tax year is 2020, we would look back the previous 5 years from 2020 on that. Of course, this applies the way I've presented it here. This applies to depreciable assets. The other area where we have a lot of conversation about capital gains is on land sales. And we're not talking about land sales here. Land sales are actually a little bit easier to calculate because land doesn't depreciate. I also wanted to provide you with an example of something that may still have depreciation left on it. So this is an item that has not fully depreciated out once it was sold. So here in this made up example, Farmer Fred has purchased a $1,500 wagon in 2013. And you can see on the slide the amount of depreciation expense associated with that item for each of the years following the purchase date. So $160 in 2013, $286.99 in 14, $112.75 in 2015. If you take that purchase price and you subtract out the depreciation that has been taken, you come up with this idea of what's called an adjusted basis. So that's how much basis you have in that asset when it's sold. And for this example, I just assumed that this wagon was sold in 2015 for $1,200. In this case, we're selling the asset for less than what we paid for it. We have to account for this adjusted basis issue. So here we're going to treat $261 as ordinary income, or the difference between the actual sales price less the adjusted basis on that. So to summarize the ordinary versus capital gain thing, that the big thing to point out there is that one, be aware whenever you're selling equipment, especially if you're selling big ticket items, that you're most likely going to have an ordinary income effect associated with that. And two, it may be not necessarily difficult, but time consuming to calculate what that gain is. So I always advise anybody when they sell something, you know, that may have an impact on their overall tax situation, make sure they get with their tax preparer as soon as possible, so that tax preparer can kind of help you think through what your taxable situation is going to look like based on that scenario. Now, cattle are treated a little bit different because we've got breeding cattle versus non-breeding cattle and purchased animals versus raised animals. So let's say that you know, you've went through this conference and you realize that you know, your cows aren't producing enough, and you're going to call, like Kenny said, you're going to call to the point that the dog got nervous, and you're going to sell some of these cows that you've purchased in the past. If you sell that breeding animal, and it's very important that you realize that we're just talking about breeding livestock here. If you sell that breeding animal less than the purchase price, then it's just going to be ordinary income or an ordinary loss, depending on how the numbers work out. Same way with the tractor. If you sell that breeding animal for more than you purchased it for, then you may have a scenario where you have an ordinary income or a capital gain. So that follows very much like it does on the equipment side of things. However, if it's breeding cattle that you've held for 24 months or longer, then you get to treat that as a 1231 gain, regardless of whether you've purchased that animal or you actually raise that animal yourself. So what I also like to tell people in this scenario, typically what happens when it's tax time, you show up at your tax preparer and you've got, you know, either your bank records or you went through and summarized everything, and they're on the line that says livestock sales. You put down how many animals that you sold. You may be putting yourself at a tax disadvantage by not disclosing to your tax preparer that if you had any animals that fell in this category, any breeding animals that you had held for longer than 24 months, because they're going to be taxed differently than animals that differently than breeding animals that you have held for less than 24 months. And there's no way for your tax accountant to know that unless, you know, there are animals that are on the depreciation schedule and you clearly identify which ones off the depreciation schedule you have sold. So just be aware of that. Make sure you give that tax preparer, if you're not doing your own taxes, as much information on those transactions as you can, because it will help you in most cases to claim those as a Section 1231 gain, as opposed to just lumping all that together up on the top part of that Schedule F and paying ordinary income tax on that. While we're talking about breeding animals, there's a couple other farm-related or farm-specific pieces of the Internal Revenue Code that deals with involuntary conversion of draft and breeding animals that I want to bring to your attention as well. So involuntary conversion is, of course, something that you're doing involuntarily under normal circumstances. You would not want to do, but conditions exist such that you are taking these actions. So the first piece of the Internal Revenue Code I want to talk about is Section 133E. And this tells us that a producer who sells more draft, breeding, or dairy animals than normal due to weather-related conditions can defer the gain for up to 2 years. Once again, I'm going to point out that I'm talking about draft and breeding animals here. You can delay that gain for up to 2 years. So let's say that we had a drought, a flood, something that I've got to sell animals. I'm not going to have enough feed. The tax code allows me to do that and not have to pay taxes on the gains of that, assuming that I replace those animals that I sold with like-kind animals within 2 years. The interesting thing or point of note here on IRC's section 1033E is that a disaster declaration is not required, but you must be able to show that the weather-related conditions forced your sales above normal. The delay of gain can actually be extended to 4 years. So you actually can get up to 4 years to do this replacement and not just 2 if there is a persistent weather condition. There's actually been some movement on this particular piece of the Internal Revenue Code back in August of last year. The Internal Revenue Service issued Notice 2020-74, which actually addressed this issue in more detail. And it told us that you may be able to actually extend that up to 5 years. And it gets very technical about why that came about, but just know that you have at least 2, you may get 4, and if the conditions are met, you may actually be able to go up to 5. The other nice thing about this piece of code is that if the persistent weather condition lasts 3 years or longer, and it makes it infeasible for you to replace with the identical livestock, then you can actually replace those animals with any kind of business property. So you have quite a bit of flexibility there. So once again, a quick example just to kind of think through how this might work. Let's say that I normally sell 5 cows. I had a drought in the fall. I'm going to sell 20 cows because I'm not going to have enough stockpile. I'm not going to have enough hay. I can defer the gain on those 15 cows if I purchase replacements in the next 2 years. I can't defer it on the whole 20. I can only defer it on the amount of animals that I sold above normal, but still I can not include those 15 cows as taxable income. My tax basis in those replacement livestock, the ones that I have to purchase in the next 2 years or possibly 4, depending on the persistent weather condition criteria, is going to be equal to the basis in the livestock that I sold, plus any additional amount invested in replacement livestock that exceeded the proceeds from the sale of the 15 that I sold above normal. If the animals are not replaced or replacement cost is less than the gain from the sale, then you actually have to go back and file an amended tax return and report that as a gain on the year in which it actually occurred. You know, in most cases, if you're selling cull cows, or not cull cows, but if you're selling breeding cows, and you're probably going to sell your lesser ones, so to speak. So you're probably not going to be an issue that you're going to spend less replacing them than what you got for selling them. But just know that there is that caveat there that if you don't actually replace these animals, or the cost of replacement is less than what you gained in the sale, then you got to do this amendment here. So assume that in my example here, assume that these animals were raised, so I have a 0 tax basis in them, so I have nothing on the depreciation schedule. These are cows that I've developed out of my own herd, and I sell them for $500 each. All this is just for simple math, folks. So my gain would be $7,500, 500 times 15 head. So within 2 years, if I purchase 15 more head are purchased for $500, then I have nothing to, no taxable situation on my income tax return, and I would have a $0 basis in these animals that I have replaced. If, however, in those 2 years, I replaced these 15 head with animals that cost me $600, then my new basis in this livestock and what I would put on my depreciation schedule would be $100 per head. The $600 cost that they cost to purchase the replacements less the $500 in proceeds that I got when I sold those 15 head. Now assume that we purchased beef cows with $200 remaining basis and sold for $500 each. I just worked through the math there to show you that in this case, the replacements cost $600. The tax basis would be $300. Just to kind of give you some ideas of how all this kind of flows together here. To make this election, if you're in this situation where you have sold animals, breeding animals in excess of normal due to a weather-related condition, you do still have to tell the Internal Revenue Service about it. So you have to do what is called making an election. Making an election on your tax return. And on this election, you have to include things as listed here on this slide: your name, address, ID number, so your social security number or your EIN. You have to provide evidence of the weather-related conditions that forced the sale. This is where pictures come in great, and newspaper clippings, screenshots off of the news websites, for example. You have to actually tell the IRS why that weather-related condition forced the sale. You have to clearly identify both the number of the animals and the kind of the animals sold. So 15 black Angus cows, for example. You also have to tell the IRS the number and kind of livestock sold that would have normally been sold. And there is no specific formula to follow here, but the convention is a 3-year average. So you go back and look over the previous 3 years, how many would you have normally sold? And that is your basis for determining how many you sold above normal. You have to actually calculate the realized gain on the transaction, even though you're not going to pay taxes on it. And then you have to report also to the IRS the amount of the income that you have postponed as a result of making the selection. I also just gave you there's a lot of information there that I showed you on the previous slide, but this is what an example election statement looks like. And you can find this at ruraltax.org as well. I always encourage people to only include what the IRS defines as necessary to include. Don't give them more information than they ask for. That's just always a good move with the IRS. All right, let's talk about Internal Revenue Code section 451E, which actually is G now. And so this is a 1-year deferral for market animals. 1033E was breeding. This is for market. There is a big distinction between this one for market animals and the one I was just discussing. And for this one, there must be a federally recognized and declared disaster, and that disaster area must be eligible to receive federal assistance. And so the idea here is kind of the same. The time limits are not the same. You can defer for 1 tax year the income of certain livestock due to weather-related conditions. It's the same criteria as far as sales in excess of normal. And if the animals are not replaced, and you have to report the gain that you would have had on the following year's tax return. For this condition, or to exercise this code section, you have to be in farming and be a farmer by the IRS's definition. You have to be a cash method accounting bookkeeper. You must be able to document that the sales would not have occurred in a normal year. So you go back and look and be able to prove to them that in a normal year, you wouldn't have sold as many as you did, market animals, that is. And then you have to be able to, once again, tell them about the weather-related disaster, which they should know anyway because it's federally designated and eligible for assistance. You have to make an election in this case as well. And so this is very similar to the previous election. Once again, information about who you are, the declaration that you're making, the evidence of the weather condition, livestock that normally would have been sold, what were actually sold, and then the amount of the income that was actually deferred there as well. Once again, this is actually 451G, not E. So this slide is correct, but this is out of the National Income Tax Workbook, but just another example of a election statement. This is literally something that gets typed out and sent to the IRS with your tax return. And it just covers all those things in that previous slide, you know, name, address, location, referencing the Internal Revenue Code that you're using, so on and so forth. So in summary on those two things, I don't expect you to remember all the details associated with that. I just want you to remember that if you're in a situation where you're forced to sell livestock in excess of normal, especially breeding livestock, because it's a little bit easier to execute that code section, to make note of that mentally and think through how you might be able to save yourself some taxes on, you know, being able to replace some of those animals or replace them with other property, even possibly. All right, this is the second to last topic I'm going to cover as far as taxes are concerned, and this is farm income tax averaging. once again, this is an area that in my experience is really underused by a lot of accountants or tax preparers. And it's a pretty neat thing that exists only for farmers. And so I always like to talk people through it. I'm going to show you a lot of numbers. We're going to talk about different tax brackets. There's going to be some calculations. Try not to get too caught up in the minute detail on this. My goal here is just to let you know that it exists, and it's a way to potentially save you a lot of taxes, depending on what your tax situation is. That being said, another reason I don't want you to get too caught up in the numbers is if you did actually print out the slides and you're looking at them, you're going to realize that I changed quite a bit on these slides because I found a mistake right before, about an hour before we went live here. So overall, the teaching is still the same. The way the tool is used is the same, but I will talk you through all that. So it's a strategic farm income tax management strategy. It's used to smooth tax liability over time. So Congress realized that farmers were going to be subject to, potentially choppy income, so to speak, or you may have years where you have high income followed by years where you have not such high income. And that is relatively inconsistent with most people who have, an off the farm job where their income is pretty predictable over time. So this tool allows you to spread that income out and smooth your tax liability over time, so that you're not hit with huge tax liabilities one year and no tax liabilities the next year. So what you get to do is you get to elect to spread farm income out over 3 previous years that are known as base years. So to me, this is much easier to see through an example. And so this is where you'll start seeing the differences in the slides that were sent to you before versus now. In this example, I'm using it under a married filing joint scenario, assuming that in 2016, this couple had 0 taxable income, 2017, $5,000 of taxable income, 2018, $10,000 of taxable income. And then in 2019, all of a sudden, their income jumped up to $105,000. Sometimes people say, how likely is that? You actually, at least in my experience, you can see those kind of fluctuations in agriculture quite a bit, largely beginning in young farmers, and when I say that, I'm thinking about farmers that have been farming, 10 years or less, because a lot of times you have so much depreciation in those first several years that your taxable income can be very low, or you have a year where you have a lot of government payments or something like that, and everything just hits right, and all of a sudden, you made a lot more money than what you're used to making. One point I need to point out here is that taxable income in these 3 base years, 16, 17, and 18, is total taxable income. But in 2019, we're only looking at net farm income. The reason is that farm income averaging, whenever you choose to income average over the previous 3 base years, you have to average that over all of your taxable income, not just your farm income. That's only going to matter in scenarios where you have off farm income. But for a lot of us, that's, important to point out. So if you have off farm income, just know that you have to take that off farm income into account those previous years as well. So if I just looked at $105,000 on the federal tax side, married filing joint, for 2019, tax liability on that, just income tax liability, we're not talking about self-employment tax here, just income tax liability would have been $14,817. And you can see, how that breaks out in each tax bracket there. So if we were to think about our tax brackets as a cylinder or a bucket that we're filling up, this is kind of what it would look like. Now, this is not exactly drawn to scale or anything like that, but it's just a good visual representation that I think is helpful when we think about spreading this income out over previous years. So if we did that also for 2016 and 17, 2016 through 2018, you'll see that 16, there's no taxable income. So we've got nothing in that cylinder and just a little bit in those other 2 years. So more specifically, our 10 and 15% tax brackets are completely wide open for 16. We've got $13,650 of room left in our 10% tax bracket for 17 and $9,050 remaining in our 10% tax bracket for 2018. If we go back and look at our 2019 and think about how filled up our tax brackets are, we're actually $65,525 above our 12% income tax bracket for that year. So what I want to do now is just go back to these base years and pull, just, basically take a slice off the bottom of these brackets so we can look at them a little closer. So that's all I've done here is just cut the tops off so that you can think about this as a bucket that we're filling up or a cylinder we're pouring water into. What we can do now is we can take our 2019 farm income and divide it by 3 and elect to move $35,000 of farm income from 2019 into these previous tax years. It is important to note that it has to be proportional. So it has to be an equal share in each year that you move back. And you can actually elect anywhere from $1 to the full net farm income too. So there's some even strategic abilities here to change this around a little bit too. But all I'm going to do is just take that 2019 farm income, divide by 3, and I'm going to drop $35,000 in my 2016 cylinder that's not filled up. Same thing for 2017, same thing for 2018. And the beautiful thing about this is instead of being in those higher tax brackets for 2019, I can take that income and get it taxed at those unused portions of those tax brackets in those previous years. So I'm taxing $35,000 at between 10 and 15% in 16, same thing for 17, and I'm in the 10 to 12% for 2018. Just remember too that we had some pretty significant income tax legislation changes for 2018 that widened the brackets and actually inserted another range in there between the 10 and 15% brackets. So that's why it wasn't a mistake. That's why we do have this 12% bracket. That was because of those tax law changes that were effective for 2018. At the end of the day, why I wanted to show this to you is that if we go back and we average that $105,000 over those previous 3 years, we can lower that income tax down to $4,319. Before we averaged, it was $14,817. After we averaged, it was $4,319. We actually saved ourselves almost $10,500 of taxes, and we did not have to commit fraud one single time in doing so. Now, it's going to depend very much on the specifics of your operation, what your previous taxable income is, what your current tax year income is, so on and so forth. But in any time that you have a significant jump in your income, you need to remind your tax preparer about Schedule J, or farm income averaging, as a potential to save you income taxes. Sometimes people ask me, why is it that I don't see it used a whole lot? I think the biggest reason is that farmers make up a real small percentage of the population, and therefore we make up a smaller percentage of tax returns that are completed. And this is a tool that is only open to farmers. So just be aware that it exists. And hopefully if you find yourself in a situation like that, you'll be able to use it and save yourself some taxes. The last topic I'm going to talk to you about is easing the concerns of multiple year farm losses, this concept of hobby losses versus farm losses. And this is something that I've spent a lot of my career talking about, because we always get a little nervous when if we don't show profit on a business for a period of time. And specifically, Congress tells us that in order for us to be able to deduct our expenses in excess of income, we've got to be engaged in that activity for profit. Congress defines profit in this context as being income greater than expenses while you're including depreciation on capital assets as an expense. And there's this safe harbor where you're automatically not considered a hobby if you have a profit in any 3 out of 5 years. That's for all businesses. If you happen to be an equine, it's 2 out of 7 years. Failure to meet this profitability test does not automatically make you a hobby venture. What it does do is it does give the IRS justifications to dig deeper into your books and take a look around and see what's going on. So I always get asked, okay, I've had a loss for several years. I don't meet the 3 out of 5 rule. What do I do? The IRS has addressed this and they have provided 9 areas of consideration that they look at when it comes to determining if a business is a true business or if it's a hobby. And they're all subjective. So I'm going to just walk you through these 9 areas real quick and give you some thoughts on them as well. The first question that they look at is that they ask, is this activity being carried out in a business-like manner? How do you show that it's a business-like manner? Having a separate checking account for your business is one way. Having a business plan is another way. I always encourage everybody to have a written business plan for this, if for no other reason, this reason alone. Two, they look at the expertise of you and your advisors. So, that's hard to prove too, like how much do you know about farming? But this really comes into play, if I was a medical doctor and never had done anything on the farm, but I'm running, a cow herd all by myself and I'm losing a lot of money, and all my advisors happen to be other doctors in my in my medical practice, and they don't know anything about farming either, that might be an issue. So I always encourage people to, keep track of extension meetings that they go to, and, think through, if you ever get confronted with this, the conversations that you've had with, extension agents and other people in the field, and then keep documentations of attending things like this conference here, because it shows that you are trying to educate yourself in the area that you're engaged in. They look at the quantity of time that's being invested in the activity by you in the business. Not saying that you have to keep a time clock, but you need to be able to show or prove that this isn't something that you just do occasionally. They look at whether or not there's an expectation of asset appreciation. That is an area that I cannot help you with because I don't know how you prove that. I guess if they ask if you have an expectation of asset appreciation, you just nod and say yes. They look to see if you've ever done this before. Not that that is a bad thing if you've done this before and failed, but they do take that into consideration, especially if you've done it many times before and failed. They look at what the history is, previous profits and losses. So they look outside that 5-year window, and they will actually go 0.7. They'll actually go back as far as they can to see that to see if you've ever made any money at all. So have you ever made any money is, will help you too. Are you engaged in other income generating activities? This area of consideration really applies to people that have, very high earning off the farm jobs and happen to have significant losses on their farm. And the IRS has actually been very open about that and said that they're looking at and auditing people over a certain income threshold. And it's pretty high by my standards. I think it's $1 million or more. But if you're making a whole lot of money off the farm, they're going to start looking a whole lot more at those farm losses. And last but not least, they look to see if you're having any fun, because there's nothing that the IRS hates more than you having fun. I'm joking mostly, but they do look at the presence of recreation or pleasure. So if you're doing this in a way in which it indicates that you're doing it for fun, that's a problem or could be a problem. This really kind of goes to the fact, if you're going out to farm meetings that happen to be in really nice tropical areas, and it's clearly that you're just on vacation and not actually learning anything, that could be problematic. In general, I tell people not to worry about it too much. Just keep doing the right things, and you'll be fine in these scenarios. So get that business plan. Try not to defraud the government any more than the average American citizen, and try to be as honest as you can, and don't worry about it. With that being said, that finishes my presentation. And are we going to take questions, Becky?
Yep, we've got several, but we'll do a few right now, and then we will save the rest for the end of the evening. Perfect. So the first question is, can you explain the general difference in tax rates from Section 1231 and 1235?
So yes, the Section 1245, or when you have a 1245 gain and you're going to pay ordinary income taxes, those are going to be based on those amounts that I showed you, the normal tax rates that we think about, whereas capital gains maxes out at 20%. So if you're a high income earner or you have a lot of gains, it's going to be more tax advantageous to have a capital gain than a 1245 gain.
So to build off of that, we just have a couple specific examples. So does 1231 loss offset depreciable assets such as buildings if you were to sell them and have a gain?
It would depend on the type of the gain. So a 1231 loss, unless they're asking about in the same time period, and then the answer could be possibly yes. Yeah, so if you had a 1231 loss and a 1245 or a 1231 gain in the same time period, yes, they will reduce each other. They'll offset each other.
And then what if you trade the tractor in for a new tractor? I think this is going back to your original example about the tractor. Can you offset the gain to the basis of the new tractor?
Used to be yes. After 2018, no. So now that's a 2 taxable event or 2 events in your tax return. When you trade that tractor in, what you get in trade is treated as a sell, and then you get the full basis of the new tractor. But with Section 179, in a lot of cases, you can handle that to offset that, but it's just an extra step.
And then the last question before we move on to Greg is, can you comment more on self-employment taxes versus other types of taxes?
Sure. So broadly speaking, we have 3 major taxes. We've got capital gains, we've got ordinary income, and we've got self-employment tax. Everybody's subject to everybody's subject to ordinary income taxes. Capital gains applies only when you have a capital gain event, but self-employed people have to pay self-employment taxes. This would be the same thing as what's being withheld for Social Security, Medicare from your paycheck if you were employed off the farm. And it happens to be 15.3%. The thing about self-employment tax is you do actually get to count half of your self-employment tax off as an expense, but you still got to come up with that 15.3% of your taxable income or your earned income from your business.
Great. I'll remind the attendees, if you think of another question for Jonathan, feel free to continue to use the Q&A box. And we will save the open questions that we have right now to the end of the evening, and we'll get them all addressed at that time.
Perfect.
Greg, I'll turn it over to you.
All right, thank you. Okay, well, I guess we have reached this presentation, not just of the evening, but also the overall conference. So if you're still with us, thank you for staying with us. I'd like to maybe this is a good time to thank Becky Thompson and Nicole Atherton for handling pretty much all the logistics of this conference and letting the 3 of us really concentrate on the presentations and delivery. It was a team event to put this on, so thanks to everyone. All right, so what I'm going to cover in this last presentation essentially is what I'm calling profitable hay feeding amounts, so number of days that we really want to target to be profitable. That relates directly, and we'll discuss this in detail, to your stocking rate. In other words, your stocking rate will basically impact how much hay you're going to have to feed. And just a very brief few minutes, we'll talk about the consequence of being overstocked at the very end. All right, so one thing I want to go back, this is kind of what we covered on the first evening. And this is what we came up as our return to land and labor if we were selling kind of longer run expectation, that $1.50 steer heifer average. So there were our costs, or the adjusted revenue, our cash costs, and then our depreciation interest. And that's how we came up with that $112 return to land and labor. Of course, that was an example, and many farms will be both below and above that. The thing I want to point out with the costs that we came up with, or one of the assumptions, was that for hay that you were feeding 2.5 tons per cow. And we never really talked about that. And essentially I'm going to discuss that particular assumption in detail here the rest of this presentation. In other words, is that the amount of hay that we want to be targeting to be profitable, or should it be less or more, et cetera? And we'll answer that. So to help us, and before we get into the details, let's first look at this kind of 2 different ways, kind of more broad scale before we dig into the details. So the first thing I want you to think about is, let's say we have a 40-acre farm and we've got 20 cows out there right now. And let's say currently we're feeding about 120 days of hay. And we're thinking about reducing that, or getting to a point that we can reduce our hay feeding. So really the final way that we can do that, and there are management practices that we can put in place, as an example, maybe rotational grazing, and there are some other things that we could do, but in the end, the last thing that we can really do to reduce those hay feeding days is basically cut our stocking rate, right? So if we go from 20 to 15, that might put us down to say 90 hay feeding days. And if we cut another 5 cows, that may put us down to 60 hay feeding days. The question though is it going to be more profitable to be at 60 hay feeding days with essentially 10 cows, or maybe 90 days with 15 cows, or 20 cows and 120 days of hay feeding? And essentially that's the question that we're going to answer here. So think about this 4x4 matrix here, and at the top we have high hay cost and low hay cost. I'll define that here in a minute, or give you 2 different examples of that. And on the left-hand side, think of that as low base profitability and then high base profitability. And what we're going to do is look at the 2 extremes to help you kind of get a feel for how this works. Because the amount of hay that you may want to feed may be a function of both your hay cost and the base profitability. And so hopefully you'll see that here. So let's start with high hay cost and low base profitability. So high hay cost I'm defining here is, or an example I'll give here is, let's say you're buying your hay, and let's say that a 5x5 bale is costing you $50 a bale, so about $100 a ton. And let's say it's not even that great quality, maybe 8% protein. And let's say low base profitability means that you're selling your calves for about $1 a pound. Far below the levels that we've seen in years and years. In that situation, would you want a whole bunch of cows on that farm and feed a lot of hay, or would you want as few cows kind of as possible and feed essentially next to no hay in that type of situation? Hopefully the answer is obvious. You want a very low stocking rate. If that was kind of your expectation for, like Kenny said, you want to look at this for a long term, not just current year, but say the next 5-6 years or potentially longer. Now let's look at the other extreme now. So this would be low hay cost and high base profitability. So here, let's say now you're buying those 5x5 bales for $25 a roll, and they're 14% protein. And let's say high base profitability is you're selling your calves for $2.50 a pound, just like maybe you were in 2014 if you hit the market right at kind of its peak. In that situation, would you want few cows and not feed much hay, or would you want a whole bunch of cows to sell a bunch of calves, and you're not really concerned at all that you have to feed a whole lot of hay? And the answer probably, and let's be honest here, we all want a very high stocking rate in that situation. So those are the 2 extremes. Obviously, most realistic scenarios are going to be somewhere between there, and that's what we're going to look at the rest of this presentation. So we are going to look at 2 different stocking rate scenarios, and we'll go through kind of the details of both of those. The first one is number 1, stocking rate scenario number 1. We're going to start on both scenarios. We're going to start at 150 hay feeding days, so roughly 5 months of feeding. And both of them, we will start at 57 cows. So let me first say, this is going to be a 100-acre farm. It's all pasture. We're going to, if on our hay, we're going to get that, either buy it or we're going to cut it somewhere else, not in that 100 acres, just to kind of, not have any confusion or on that interaction between hay and pasture on the same farm. So we're starting, and let's assume that we're rotational grazing. We've got good fertility, and in general, we've got good management. So in other words, this is probably upper end of the number of cows we could have to get on 100 acres to get those various hay feeding days. So we'll start with 150 hay feeding days here. We've got 57 cows. We're going to essentially go down in 1 month increments. So to get down to 4 months of hay feeding, we're going to have about 50 cows. To get down to 3 months, about 41, 42, 2 months, 34, 1 month, 28. And to get down, not necessarily that we want to be that low, but if we try to get down to essentially no hay feeding, and realistically, that probably means, we want 1 or 2 weeks on hand just in case we get a foot of snow. But we'd be somewhere between 23 and 24 cows to get down to that level. Now, the next scenario, number 2, essentially starts out the same. The number of cows that we need to essentially get rid of to get down to 0 hay feeding days just goes a little bit slower. Since 23, 24, down at the bottom, we've got 28, 29. So in other words, we're having to destock just a little slower to get down to those same hay feeding days. And the reason I'm showing 2 different scenarios is we don't know for sure what is the most realistic. There's no good research on this, and we'll probably never get it, because this would be what is called systems types research. We're generally not that good at producing that here at the universities. So this really is based largely on producers that have tried to get down to very low numbers of hay feeding days and kind of, talking to them in terms of how many cows did they have to cut in kind of equivalent situations to get there. So obviously there are different opinions, and that's why I'm giving you two different stocking rate scenarios. What I essentially do at the very end, I average the two, since I don't know which one is the most accurate. If I had to guess, if I had to put my money on one, I'd probably put it on number one. But since I don't know for sure, I just simply average the two. You'll have the ability, if you think number one is more realistic for you, or number two, you can actually pick one or the other and refine your results based on those. Now, one thing that I didn't, so I've been essentially doing the same type of presentation for about 4 years now. Again, hopefully it's improved over time. One thing I initially did not do that I talked to someone after one of the presentations, he had a really good point about forage quality. And essentially what he said was, when you're stocked at very high levels, for instance, at 150 hay feeding days, the cows during the grazing season are not going to be able to be as selective as they would be if they had more acres per cow. So in other words, performance is not going to be as good at really high stocking rates during the grazing season. And then the second factor in there is you are starting to feed hay earlier at those high stocking rates. And generally our hay quality is not as good as our pasture quality. So in other words, if we're on hay longer with a high stocking rate scenario versus low, performance can go down just because we're on lower quality forage with that hay versus the pasture. So for those two reasons, basically our weaning rate is going to start gradually going up as our stocking rate goes down, and our weaning weights are also going to go up. So basically we start at 85% and they start inching up, and basically stop at 88% when we get down to 0 and 30 hay feeding days, and stop at 565 weaning weights, and that would be an average steer heifer when we get down to that same level. Net hay cost, you will have 3 choices to pick from. So essentially when we get to the result summary, you essentially will pick which of these is most representative for your farm. We'll go through a few examples to help you determine what that might be. But essentially it's going to be the cost of the hay, whether you buy it or make it. And if you make it, we'll discuss that a little bit later on in terms of how to come to that number. But essentially you'll start with that number, and then you'll subtract out in that nutrient value, essentially what we covered yesterday with bale grazing in a few different examples. And we'll go over a few examples tonight. So you'll pick either $50, $60, or $70 a ton net hay cost, again, after subtracting out the nutrient value. So a couple examples here, just math wise, and then we'll look at a few pictures. So if the cost of the hay is $70 and you estimate the net nutrient value is 10, again, just subtract the difference, and we're at $60 a ton. And that's what you would choose if that was representative of your farm. If you estimate the cost to be $80 a ton and you estimate the net nutrient value to be 20, and again, it becomes the same number, but just different example. And again, if that was representative of your farm, you'd choose a $60 net hay cost, the one that's right in the middle. All right, so let's look at a 3 pictures just to help you calibrate maybe what is a realistic nutrient values. So this is kind of typical dry lot. It does not look like they're doing a very good job of getting any of those nutrients there. So very low, it may be close to 0, at best probably $5 a ton. So just roughly use that to calibrate your situation. Here we've improved just a little bit. We saw this picture yesterday. But again, most of the nutrients are probably ending up within 100 feet or so of that feeding structure and probably not utilized at all. So doing a little bit better, maybe $5 to $10 per ton. And again, we saw this picture yesterday. This is bale grazing. We obviously we're doing a whole lot better. So somewhere between 20, 25, potentially even maybe a little bit higher than that. But I generally would probably say about $25 a ton if we're doing a really good job of bale grazing or enrolling our hay. Now, the next thing I want you to think about is, and we're not going to look at all the details here, so let's think about it more conceptually. I'll show you numbers, but I won't spend a lot of time on the numbers. But we are looking essentially at the same farm, same 100-acre farm. All we're going to do essentially is vary the number of cows, right? And so think about what costs will either increase or decrease as we change that stocking rate. So in other words, if we start at 50 cows and we cut that in half, just to make it kind of easy to think about, to 25, what costs are going to change proportionally to that. In other words, what costs are going to be cut in half, what costs may not change at all, and then what costs may change, but they may not be half of what they originally were. So I'll give you a few examples of each. So one example of a cost that would change proportionally would be cut exactly in half, maybe something like mineral, right? If we have 50 cows, every cow is going to use about the same amount of mineral. So probably our mineral costs will be about exactly half of what it was before. That would be a good example. Now, in this case, the cattle are drinking water, so essentially it's not a cost, but if we are on county water type situation, obviously our water bills would be expected to be half. Now, what are some costs that aren't going to change at all? So something like equipment, depreciation and interest, at least the fixed component of depreciation. And there's, again, usually a small component at small production levels that is variable, but the bulk of depreciation, all interest, would be fixed. Wouldn't matter if we had 50 cows or 25. Same for our buildings, fencing, handling facilities, those type of things. We'd have pretty much all the same costs, other than maybe just a little bit of use depreciation. So those would be ones that don't change at all. What would be some costs that might change, but not proportionally? I think labor is a good example. So if you're out there, in the summertime checking on cows, doesn't matter if you have 50 or 25, you're probably going to go out there the same number of times. It might take you a little bit quicker to check over the 25 than 50, but certainly not half the time, right? And a good chunk of that time is just putting on your boots, walking out to where they are. That's not going to change. So I've tried to account for all those different costs. Again, I'm not going to go over every single one here. I'll just kind of lay them out. I'll let you look at them later if you want to do that. But basically, what I'm calling, when I add all those up, total specified costs come up to $475. And we'll talk about if your costs are higher or lower than that, at the very end, we can adjust results based on that. All right, so I'm going to use an average 525-pound steer heifer. So that might mean a 500-pound heifer, 550-pound steer, something in that range. I'm going to start out with a $1.40 base price, and then 85% weaning rate, and realize that would be the base. And as we go down in weaning, as we go down in stocking rate, that weaning rate's going to go up gradually to 88%. And I'm sorry, same for the weight. That 525 pounds is going to gradually go up to, and the number escapes me out, but something like 565, I think. So before we get into details, and I will show you the details here in just a little bit, but before we do that, I essentially want to cut to the chase, just show you a summary of the results. And the reason I want to do that right now is because when we get into the details, just from past experience, I may lose a few people. In other words, you might get confused. So before that happens, I just want to kind of give you the main message before you maybe become frustrated and throw your hands up. So let's do that first. We'll go into details after that. By the way, I have changed those details. I've made a few changes. Hopefully it will avoid confusion. We will find out. So as a summary, you've got the $50, $60, and $70 ton net hay price. So pick which one you think is most representative. And then on the right, I'm just going to give you the summary of how many hay feeding days will be most profitable in each of those situations. So let's start with $50. So in that situation, the most profitable number of hay feeding days, essentially 90 days or about 3 months. $60, it would be 60 to 90 days, so 2 to 3 months. $70, it would be 30 to 60 days, so 1 to 2 months. Now, what are the typical number of hay feeding days we typically see here in Kentucky? Now, realizing we don't have actual statistics, I do generally try to ask our county agents when I'm on farm visits. I ask farmers, and so again, we have no official statistics, but my best estimate based on kind of all that informal information is probably somewhere between 120 and 130 hay feeding days. And that may mean, 1 year they're feeding 100 days, another year, say a drought, they're feeding 150 kind of on average. So just based on that, looks like there's a big difference between what is most profitable and what is actually being fed out there on those farms. So we'll refine these results, and you can see in terms of actual dollar numbers what it may mean here in a minute. So if you are producing your own hay, which my guess is most people are that are watching this, very quickly, I'm just going to show you how to maybe estimate that if you don't have your own good records. And even if you do, there's something that you want to modify. for what the analysis we're doing here this evening that you may not have thought about. So just very quickly, we'll go through this. So you saw this diagram the first evening, Tuesday evening. I'll just go through it again. So this would be with that scenario one, the $60,000 of initial hay capital. So if we make 100 tons of hay with that equipment, can we draw that line up, hit that diagram, draw a line to the left? Again, about $27, $28 is what we have in depreciation interest on a per ton level. And as we go down in production to 50 tons, that cost goes up. And we went in the details of why that's occurring. So what I want to make sure we understand here is, let's say, and I'm just going to give an example. Let's say that because we're lowering our stocking rate, we don't need to feed as much hay. So let's say we lowered our stocking rate. We were feeding 100 tons of hay. We lowered our stocking rate. Now we only need to feed 50 tons. And so we're only making half as much hay. What happens is, even though we think that we're saving all that money on the hay that we're not producing, the answer is we're not saving as much as we think, because most of the depreciation, all the interest is simply shifted to fewer tons that we produce. In this case, $24 gets shifted essentially to the 50 tons that we're producing versus 100 tons before. So what you want to do, and I'll give an example to help you understand this, is if your overall hay costs, including everything, depreciation interest, is $100 a ton, it's say the 100-ton production level. In the case of going down to 50, you would subtract that $24 that you essentially are going to shift to the 50 tons for every ton that you produce there. So in other words, subtract 24 from $100, that makes it $76. That would be the true cost that you're going to defer or get rid of by making less hay, not the full $100 a ton. So in other words, start with that 76, then subtract out the net nutrient value that you estimate, and that will give you your final number. So if you're producing your own hay, and if you don't have good production cost records, which my guess is a lot of people will fall in that category, simply pick something in the range I'm going to recommend here. Pick somewhere in that $60 to $70 ton range, subtract out your net nutrient value, and that will put you very close to being probably where you need to. The cost that varies most from one operation to the next is that depreciation interest charge. Yes, a lot of the other costs vary, but nothing close like we talked about in day one compared to the depreciation interest. So once we remove that, the production costs of other farms isn't that big a range. So anyways, if you have records, use them. If you don't, just choose somewhere between $60 and $70 a ton, subtract out that net nutrient value, that will put you in the ballpark. So what is the appropriate stocking rate or hay feeding days for most farms? So if we assume most people make their hay, which they probably do, once we subtract out that net nutrient value in typical feeding conditions, probably somewhere between 60 and 90 days is where you want to be, or 2 to 3 months. All right, this is where we get to the detailed results. And again, hopefully I don't lose anyone. I did make a few changes, but I know in the past, there's been a little bit of confusion. We'll see. I think I've probably set up a way to avoid that. All right, so this is the detailed results. Don't panic yet for scenario number 2. I just wanted to start there, and we'll look at one here in a minute. And everything is going to be compared to the 150 hay feeding day scenario. And I'll explain. Best way to learn here is just look at a specific example and walk through it. So there's our hay feeding days, stocking rates. But what I want you to do now is just focus in on that middle column, the $60 per ton net hay cost. And so what we're going to do first is we're going to look at, assume that we're starting in 150 days. And if we want to change that, say if we want to go from 150 to 120 days, how is that going to change our profitability? And that's how this table is set up. So let me, again, just kind of walk you through it. So we're going to go from 150 to 120 days. And so when you see that 1600 that I just highlighted, what that means is when we go from 150 to 120 days, our profitability is increasing by $1,600. Now, if that number was minus 1,600, that means our profitability would drop by $1,600. But since it's positive, it means our profitability is increased by $1,600. So that's good. That means we're better off being at a stocking rate that we will feed 4 months rather than 5 months of hay. What about going from 150 days to 90 days? So going from 5 months to 3 months of hay feeding. So now we've got $2,900 in that yellow box. And again, what that means is going from 150 days to 90 days, we're going to increase our profit by $2,900. Doesn't mean that we were profitable. So in other words, we may have lost, let's say, $4,000 at 150 hay feeding days. That means we only lost what? $1,100 at the 90-day level. So it's just looking at them kind of comparatively. It doesn't tell us the overall profit. It just tells us which of the ones is most profitable and by how much. What if we go to 60 days? So again, from 150 to 60 days, we increased our profit by 3,300 in that situation. And by the way, that turns out to be the highest number in that column. So essentially that tells us that's essentially where we want to be. In other words, the most profitable stocking rate would be about 38 cows in this situation, which translates to that 60 hay feeding days. What I would recommend is don't worry so much about the actual stocking rate, because again, that will depend on, you know, your management style, the soils on the farm, et cetera. But if you focus on the hay feeding days, that will take care of itself. Now we can also do this. So far we've been comparing it to the 150 days. We can also compare with something else. So if we want to compare the 120 to the 60 hay feeding days, what we do is subtract the difference. So in other words, if we take 3,300, subtract 1,600, the difference is 1,700. So in other words, in that situation, if we went from 120 days to 60 days, we'd increase our profitability by $1,700. All right, so what I'm going to do now, even though the 3,300 or 60 days of hay feeding was the most profitable, I'm just going to say anything within a few $100s is good enough. So anything within that range is close enough that pretty much any of those scenarios could be where you want to be, and it doesn't matter too much. So anywhere up to about 90 days or 3 months of hay feeding is where you'd want to be if that represented your farm. And we can do the same for the $50 per ton net hay, and the optimal there would be somewhere between 1 month and 3 months. And we can do the same for the $70 per ton net hay, and the optimal there would be somewhere between 0 and 2 months of hay feeding. Now, one last thing I want to do on this table, just to make a point here, and then we'll go to the other stocking rate scenario, and then we'll kind of summarize the whole thing. But notice that at $70 per ton net hay, if we go from 150 hay feeding days down to 60, our profitability is increased by $4,500, which is incredible. This 100-acre farm. Now, if we divide that by the number of cows at the 2-month level, which is 38, that increases our profitability by about $120 per cow. So think about, you know, all those scenarios we went through on day one in terms of, you know, net return per cow for your labor and land, and think about increasing it by something like that. So it can do wonders. Now, in fairness, the amount of hay that we assumed that you would feed in that budget was closer to the 120 hay feeding day, not the 150. So if we look at that, in other words, if we go from 120 hay feeding days to 60 hay feeding days, that increase in profitability is $2,400, and the amount per cow comes out to be $63. So again, think about adding that to those scenarios we went over in day one. You could bring a lot of scenarios that you were not profitable up to, say, break even, somewhere in that range, or better potentially. All right, so that's where we were, or where you'd want to be if you think scenario 2 is more realistic for how stocking rate changes to get down to the various hay feeding days. Here is stocking rate number 1. And I'm just going to highlight in yellow about where you should be. Everything gets shifted up. And the reason for that is it's costing you more to essentially destock. I'm sorry, it's costing you more to drop in number of hay feeding days, because you're having to destock a little higher to get to that, or to get to those numbers. So what I'm going to do now, essentially average to. I told you, and then that's what I did. So I just kind of toggle back and forth between the two. So here's scenario 1, here's scenario 2. What I'm looking for in each of the cost categories, so the $50, $60, and $70 ton or dollar per ton net hay cost, is the overlap between the two. And so if I do that, the overlap is what you're looking at highlighted in yellow. So at $50 per ton net hay, the overlap is just right at that 3 months. And if we look at $60, the overlap is between 2 and 3 months. And at $70 per ton net hay, the overlap is between 1 and 2 months. And that's how I came up with those optimal or highest profitability hay feeding days. All right, so a few caveats to mention here, and they're important, particularly the first one. If you are, say, attending this from, say, outside the fescue belt, so if you're in the Northeast, deep South, maybe far West, the results I'm showing here will not necessarily be applicable, and I'll talk in detail about one of those here in a second. So that's the area that we're talking about. It's applicable to what's called the fescue belt. Sometimes people refer to this upper South. But that area, I'm fairly comfortable, pretty much the whole area that the results are good for, but you get outside of that and things will change. So I'll give you an example. I was actually on a email discussion with the two X's you see there. One is in northern Minnesota, one is in south central New York, and one in New York is very close to where I'm from. And these were two of my extension colleagues in these two states, also both two beef cattle producers. And the one in Minnesota, Troy Salzer, he was one that kind of initiated this. He saw a presentation that I'd done on this before, and he was wondering the same thing, you know, are the results applicable to my area? And I told him probably not, and I had my hunches. But anyways, long story short, between the discussion of the three of us, we decided, yeah, the optimal hay feeding areas, kind of when you get far north like that, are going to go up quite a bit because they get, you know, a whole lot of snow cover. So even if you are able to stockpile out of forage, in Troy's situation, he tried that a few years and he ended up losing a lot of that stockpile because it basically got ruined by the snow after it was on it for too long a period. There's some other reasons. I won't go into those details for time's sake, but basically when you get north of there, the optimal hay feeding days are going to go up. My guess would be in the deep South, it may go down. I don't know that for sure. It just depends on a lot of dynamics. So I probably better not even take a guess there. Out West, it could go up or down. If you're in the arid West, my guess would be where they don't get snow cover or very much. My guess is the optimal number of hay feeding days would probably go down. If you're in the western part of the US where they get a lot of snow, it probably goes up. And again, won't go into details on the dynamics of that, but just again, the results are really only good for that fescue belt. Another caveat here is I assume that kind of that long run average price would be about $1.40. And so if you have a different expectation for the market, it's fairly easy to adjust these results. So if you think that should be bumped up by, say, 10 cents, so up to $1.50, in the same token, it works out that if your costs are $45 less than the ones I showed in the one table about midway through, it will have the exact same effect. So either of those will have the same result. And what you'd want to do is just very roughly, you could bump the optimal number of hay feeding days up by about 20. On the same token, if that price is, or if you think the price is going to be about 10 cents less, or if your costs are about $45 higher than what I showed, it's the same thing, just in reverse. You would essentially decrease the number of hay feeding days by about 20. So it's crude, it's not exact, but it will put you in the ballpark. Third caveat, and this is the most important one, we'll talk a little bit more about this one, is essentially, I assume the same forage production in all the various stocking rate scenarios. And most of them probably that's accurate, but I'll tell you why it's probably not accurate for sure with one of them and potentially a second one. So it relates to if you get in a position like this. So if on your farm, typically by say mid-July or into August, you have pastures that look like this, you're probably overstocked from the perspective of what we're talking about in terms of optimal hay feeding days. So what happens when your pasture gets in a situation or condition like this? Obviously, there's not that much residual on this pasture. So what's happening is that soil temperature is increasing. Our cool season grasses are going to start shutting down. When they get grazed down that low, they're also going to be in a weakened state. So even if and when we get good conditions, say in the fall, for growth to occur, the grasses here are just not going to respond as quickly as if we had better residual. So what I want to point out here, and I guess the main point I'm trying to get to is, and I'm going to use yellow for where you need to be cautious and red probably where it's going to occur fairly regularly, but and this is my best guess estimate, but probably somewhere around 120 hay feeding days. Again, you'd have to think about this on average. Some years that may be 100, some years it may be 140. But on average, if that's kind of where you're at, if you have a normal year, you're probably not going to get in the situation that we just looked at. But if you have even a mild drought in late summer or going into fall, my guess is your pastures, there'll be a good chance they'll get down to that level or something close to it. And then at that point, again, it's going to be very hard for those pastures to recover. And so essentially you're going to lose part of that production that you should be getting, which I would argue is probably the most important of the year, late summer going into fall, when we typically have less of it. That's going to put you in a severe disadvantage. So I'm highlighting that as yellow as being cautious. And then the 150 hay feeding days I'm putting red, because my guess is if everything goes normal, in other words, if you kind of have normal rainfall, by late summer, typically at that stocking rate, you're probably going to get something close to that type of condition. And I call this a downward spiral because once your pastures reach that condition, it's very hard for them to recover that year. And that's in the short run. Long run, the downward spiral may even get worse, because probably the next year that may mean your long-term production may suffer a bit because the soil health aspects are starting to go downhill. So this may be easiest just to look at a few pictures to kind of understand the point, maybe drive it home. So in 2019 in central Kentucky, we had I'm not going to call it a major drought, but it definitely was a drought. And in southern Woodford County, between early August and early October, we had no appreciable rain. We had a few 1/10 of an inch, maybe 1/2 of an inch rain here and there. But at that time of year, with that little rain, basically as soon as the sun comes out or within half an hour, pretty much all evaporates. So no real appreciable rain that soaked into the soil during essentially 2 full months. This is the farm that we've bale grazed for about 10 years now. Hopefully it's obvious what side of the fence is our farm and what side is the neighbors. And yeah, this may be an extreme example. Yeah, probably the horse farm is typically overgrazed. But the point I want to make here is this picture was taken in December. So we finally got the rains, and I don't remember the exact day, it was maybe October 5th, 6th, somewhere. And for the next 3 weeks, we got really good rains. But both Kenny and I were thinking it was already into October. The grass has been fairly dormant for the last month before that. We just figured even with those rains, we figured it would green up, we'd get some growth, but we figured we'd be feeding a lot of hay that winter. And it turned out we were wrong. I mean, we fed a little bit more hay than we normally would, but nothing close to what we thought we were going to, even when we started getting the rains in October. And what we found was, as long as the pasture had good residual, and not every single pasture on our farm did, but most of the pastures that had good residual, that they weren't grubbed, they weren't grazed down really hard, those pastures took off. I mean, we have never seen the growth that we saw in that next month after we got those rains on those pastures. And the same for other farms with those kind of conditions. Now, farms that looked like they did on the other side of the fence, on the horse farm there, they did not respond. I mean, yes, they greened up, they had a little bit of growth, but basically that was about it. Those pastures were so stressed, they could not take advantage of that rain and the ideal conditions, and production suffered. By the way, every time I look at this picture, I wonder, what are those two horses saying to each other? And they're talking, they're, it's probably the proverbial grass is always greener on the other side of the fence. And unfortunately on that horse farm, the answer is it is. It's always greener on the other side of that fence. This is one of the other farms I've been working with bale grazing. They're about 80 miles away, and they got more rain. I wouldn't call theirs a drought, but they got about 2.5 inches of rain during that same 2-month period. Normally they would expect about 8 inches. So, they still only had about 1/3 of the normal rainfall during that time. And you can see, this is late November when I took that picture. You can see the absolute incredible stockpile they had, even with that little rain. And the reason, again, is they were not overstocked. And I guess I need to point that out about, go back to, we were not overstocked. And we're at a slight disadvantage. We finish animals on this farm. So, we had taken off a number of animals to be processed in fall, but we still had, a fair amount of animals that were going to be overwintered, which you're seeing here. But yeah, we were at a fairly decent stocking rate, probably not quite apples to apples with what maybe a cow herd would, but we saw the results if you were at a fairly low stocking rate. This was a regular cow-calf operation, probably even slightly stocked higher than I would have liked them to get down to maybe that 90-day hay feeding level, but not close from it. And what they did, they realized actually before we did in August that they were stocked at higher rate than we were. So they realized that they were going to quickly run out of grass if they didn't do something. So what they actually did is they started bale grazing towards the end of August at very low densities, allowed them to slow the rotation down and allowed them to fully stockpile about half their pastures that looked just about like what you're seeing there. So it worked out incredible for them. This was kind of typically what you see in central Kentucky during that time period. This was right before we got those rains, and a pasture like that would just they just did not come back when they got the rain. Yes, they greened up, they had a little bit of growth, but they just did not recover anything close to what you would if you had better residual. Now, we usually think about production for that year, and I gave you examples of how dramatically it can be during that year, but there's also an effect on the green up the following year. So in other words, how your pastures, how much residual you have on them in the fall, and how well you manage them in the fall will have a big impact on how and when you get that green up in the spring. So the next picture is going to be on the same farm. It's going to be a different pasture. It's actually one that they bale grazed in the fall. So that had been bale grazed in the fall, then rested essentially the rest of the winter time. You can actually see they're still bale grazing at very low densities here, just to slow the rotation until the pastures really get going. But I think when I put the data on here, you will be surprised at how early it is. Again, this is central Kentucky or south central Kentucky. That was March 19th of last year. Now, again, it was about 80 miles from me when I drove down there. And so I drove through a lot of the heart of Kentucky cattle country. And I can tell you, there was no other pasture I saw on that drive that looked half as good as this pasture did on March 19th. So how you managed that fall before and leaving plenty of residual will have a huge impact on that spring green up. By the way, this was April 10th on that same farm, when most farms are just starting to graze and probably maybe even shouldn't be grazing because they really don't have enough there to fully fill the cattle up. This farm was not quite ready to make hay, but they, another week after that, they probably could have started making hay if they had wanted to. Point I'm trying to get to here is, again, at that 120 hay feeding days, so probably somewhere around 4 months, you've got to be really careful or you will get in that position where you're essentially overgrazing the pastures. And at that point, you are not going to get the production that we assumed in this analysis. And almost invariably, if you're stocked at for 150 hay feeding days, and unless you have above average normal, late summer and fall in terms of rainfall, you're almost guaranteed to get close to that level. Last comment I want to make here. So again, kind of as summary, for most farms, somewhere between 2 and 3 months of hay feeding are going to be most profitable level. Again, I realize that's quite a bit different than most farms are feeding right now. I will also make the comment, and you can refine the analysis based on which your exact numbers are with those various tables. But we saw a lot of scenarios at what farms could save a couple, $2,000–3,000 by reducing their stocking rate. And one more point, when I say reduce your hay feeding, I really mean reducing your stocking rate, because we probably all know farms that probably may only feed 120 days, but they really should be feeding 150 days. In other words, for the stocking rate, they might wait until mid-December to feed hay, but they probably should have started feeding hay in early November. In other words, they're forcing their cattle to rub down those pastures. The cows are probably losing condition because they're not getting enough intake. That's not what I'm saying. So in other words, don't force your cattle to eat the pastures down. You've got to be at the appropriate stocking rate to get to that level. And then if you do that, and if you do everything else right, you will potentially have a profitable farm. In other words, I almost think stocking rate needs to be done. That's the biggest thing you've got to do. Then you've got to do all those other things we've talked about, the other 2 evenings and the rest of what we went over today. Do all that stuff right. If prices come up a little bit above $1.30 to maybe that high $1.40, $1.50 level, yeah, you're in a position where you can be profitable. And that is hopefully the goal, or that is the goal of this conference. And hopefully we'll have a number of farms that are in that position. that is the end of my formal presentation. There's my contact information. Again, feel free to contact me anytime. Kenny and Jonathan have said the same thing, so please do. That said, I think Becky has some questions now. And again, Becky, Nicole, thank you so much for handling the logistics here.
I'm happy to help, Greg. So we have a question that came through for your presentation. And I will remind all of our attendees, if you do have a question for any of our presenters, please put them in the Q&A box and we'll work through them at this time. And we will get to all of the questions that are in here. So if you stick with us, we'll work through them right now. So Greg, any thoughts on how these numbers on hay feeding days might change with a fall calving herd instead of a spring herd?
And actually, that's a really good question, because I should have told you this was based on a spring herd. So whoever asked that question realized that. But I don't think I pointed it out. So thank you, whoever asked the question. I should have pointed that out. Now for the actual question, I don't know for sure. It obviously is going to change the analysis, but I guess I have to say I just haven't done that. My gut feeling is you're going to just overall, I think, going to have a lower stocking rate, since you're essentially going to be carrying calves through the winter time. So just first of all, you're going to have a lower stocking rate. How it would change optimal hay feeding days, I don't know for sure. It's a really good question. I do not know, and I don't want to take a guess until I do that analysis. But it is a good question, and it's one I probably should address now that I've kind of got this one smoothed out. At least I think I've got it smoothed out. If people understood the details, then I've got it smoothed out.
To follow that up, does the estimated cost of minerals factor into what the calves are ingesting, or is it strictly for the cows?
So in that case, it would be for everything. And I wouldn't, so first of all, I would not be so concerned about every individual cost. Think about, so when I showed the table of costs, or think about how yours overall compared to those. And if yours are, again, I gave you two examples. If you think they're $45 higher than what I showed you, you'd actually decrease the number of hay feeding days by about 20. If my costs are $45 too high that I'm showing, you can increase your hay feeding days by about 20 days. So my advice is I wouldn't worry about those individual costs. Think about them in aggregate, compare them to yours, and you can make those adjustments.
Okay. The next question is, does the stocking rate only count brood cows, or does it count calves also?
The stocking rate were brood cows only. Yeah. Let me make another point though. So I wouldn't worry so much about the stocking rate. I would really focus on the hay feeding days, because again, I was assuming good fertility. We could have, yesterday I showed you a number of pictures on real steep slopes, Eden shale type soils. The stocking rate that you may have to have on that farm compared to, say, what you're looking at right here, may be literally half the number to get the same number of hay feeding days. So I would be more concerned about matching your stocking rate to get, so in other words, if based on the numbers, you should be at 90 hay feeding days, figure out what stocking rate you need on your farm to reach that amount of hay feeding. Again, not trying to starve the cattle in late fall to make them, to stretch out another 2 or 3 weeks. I'm sure we've all seen that, unfortunately. That's not what I mean, so that you can comfortably reach that level and still maintain good performance with the cattle.
Okay, Greg, that wraps up the questions that we have for you. I think the next question Kenny's probably going to want to answer. Kenny, farmers rush to increase the number of breeding cows when weaned calf prices are high, which in turn causes an oversupply of calves and drives down the price. So everyone is selling the cows to reduce their calf production and so on. Is there a fix for this?
Yeah, the questions about the cattle cycle really, and I think the question that Don's asking is, if we know cattle cycles exist, why do they keep happening? There's not per se a fix, because I think we all would agree these markets are impossible to predict. However, I do think we can say a couple of things. Number one, producers are going to respond to profits, and high calf prices lead to higher profits, and they're going to respond by wanting to expand. And I really think that the focus, I made the comment tonight, and then Greg said the same thing, is keep long run expected calf price in the back of your mind when you're making long run investments. So what that ultimately means is that, if bred heifer prices are extremely high beyond what you think is justified, when you look at a long-term expected average calf price, that may mean you buy fewer heifers. If you develop them on your own, right, you start with the value of your weaned heifers. If those weaned heifers are extremely valuable and you're going to tack on another $400 or $500 to get them developed and have them into your cow herd, then that may put their cost above what you think makes sense when you look at a long run expected average calf price. So I think the key is make those long-term decisions with an expectation of an average price over time. Don't chase prices based on the current market. Sorry for the long answer, Becky.
No, that was great. Thank you. I'm not sure which one of you want to address the next question, so I'll let you all decide. But is there an online example of a business plan for a cow-calf operation? I'm looking for an example to build a plan from.
So if you get around on the internet and dig around some, you can find some resources from land grant universities. I typically refer people to the University of Minnesota through their ag plan. They have a really user-friendly interface that provides some examples of ag business plans in general. It probably will not be specific to cow-calf, but it's still a very good starting point. A lot of really good usable interfaces there to help you build your own for what you need.
Great. Jonathan, we're going to move over to some of our tax questions that we received after your presentation.
Sure.
So this one concerns the 179 bonus depreciation.
Okay.
If you have a good year, could you use the bonus depreciation to buy equipment, take full depreciation, which would offset the increase in income? Of course, you would not have the depreciation expense in the future years.
Yeah, so absolutely, you could use either Section 179 or bonus depreciation. On the federal side, you basically, for most Kentucky farmers, eliminate all your taxable income from the farm. On the state side, we only have Section 179 expensing. We don't have that bonus depreciation, and our cap is a lot lower for Kentucky. It finally got moved up, but it was moved up to 100,000. So for all intents and purposes, you could reduce it up to 100,000 on the federal, on the state side, but you've got a lot more room on the federal side. The only cautionary tale to go along with accelerated depreciation, regardless of Section 179 or bonus depreciation, is that if you've got a loan tied to that, you just got to think through the fact that you're removing any deduction associated with that income you have to generate to make that loan payment in the future. And then, of course, if you sell those items that you accelerated depreciation on, you've got to recapture all that too. So it's a good tool. It's a part of the strategic tax management situation, but it needs to be used with caution as well.
Okay. The next question references back to your example of heifers. And what is the difference of selling a breeding animal that you raise versus selling the 24-month-old?
Yeah, so it's just the way the tax code is written. If you've held that breeding livestock for 24 months or longer, you get a favorable tax treatment on it. Now, that is under the assumption that you are selling breeding livestock that you've held for 24 months or longer, and they were actually being used as breeding livestock, or the intent was to use them as breeding livestock in your operation. It does not apply to somebody who's in the business of raising breeding livestock to sell. So if you're in the business of developing heifers and selling bred heifers, technically you're not able to use that same favorable tax situation.
The next question is about, it's a specific example and asking for your thoughts. I bought a pregnant heifer in December of 2020 at the stockyards. Her calf was stillborn at the end of February 2021. I sold the heifer in March of 2021 at the stockyard for a loss. Can I take the loss of the calf and the money loss of the heifer off of my taxes at the end of the year?
You can take the loss so that your loss will be whatever money you've put into that heifer while you had ownership of her, so feed, vet, that kind of stuff. And then your loss will be calculated between the purchase price and what you received for her at the stockyard. There is no additional loss because of the calf or anything like that on that one.
The next question is, does income averaging mean we have to file amended tax returns for the three previous years and pay the additional tax for those years?
That's a very good question and something I should have clarified. No, that's the beautiful thing about income averaging is that you do not have to amend any previous tax returns. You just get to use those unused portions of those previous year's tax brackets. But no, you do not have to touch those previous returns.
And this is a clarification question. Did you say tax averaging has to also include off-farm income?
Another very good question, and yes, that is what I said. It's a little bit quirky in the sense that the year in which you use it, you're averaging farm income, but when you average it over those 3 base years, you have to look at total taxable income. So if you had income outside of farm income in those previous 3 years, that is going to play into how much bracket you have left in those base years to average the farm income over.
The next one is something I think we all strive to do, but on the idea of making a profit, sometimes it seems the things I've set up for depreciation exceed my income, showing a loss, but I have had years of good farm income.
So just, I guess the question is saying that, yeah, depreciation can drive that Schedule F negative. Yeah, that's a big problem. And so there's a couple ways to think about that. One, just want to make sure that you're not overcapitalized on anything. Two, the other side of that argument is that the class lives that we use are determined by the Internal Revenue Service and not actual expectations of use of that item. So they are, in most cases, and speaking on average here, going to be front loaded. So they're going to probably depreciate quicker for tax purposes than actual use depreciation. So yeah, I didn't really answer that specifically, but yeah, that's a common thing in depreciation driving down profit.
The next one is, when a farmer is getting started and has to purchase animals and equipment, improve the land, etc., how long does the IRS take to allow you to make a profit?
It really all goes back to that 3 out of 5 rule. That's really the only thing on the books that determines whether or not they can dig in a little bit deeper. With that being said, yeah, if you're a beginning farmer or haven't been in business long, that absolutely is going to fall in your favor if you are the lucky one to get your name drawn and they start digging around. But there is no hard and fast rule as far as you have so many years before you have to show a profit if you're just starting out. But they do take that into consideration for sure.
Okay, the last question we have right now in the Q&A box, and Jonathan, it might be easier if you want to open the box because it's got some numbers in it. But
yes,
it reads, can you clarify on your slides, but you had 0 income in the first year, 5,000 in the second, and 135,000 in the third year. Why wouldn't you take the sum of the 3 years and then divide by 3 rather than the last year 105,000 divided by 3 for the income tax averaging?
Okay, so yeah, and I hope my slides weren't like that, but yeah, the first year there was 0, and then I think it was 5, and then it was 10. So $0 for 16, 5 for 17, 10 for 18. And then we had 105,000 in 2019. And so we average that 105,000. So we have to take that the year in which we're averaging, divide it by 3 to spread over those 3 previous years. And, as has been said, anybody that has any specific questions, feel free to reach out to me. Be more than happy to give you some insights on anything.
Great, guys. I really appreciate it. That seems to be all the questions we have right now. Kenny, I think you have a CAPE education code to share with the group.
So you should be seeing it now. Using my very creative format. Here we go. CCPCCTHUR. So put that in. You get the form from the county agent office, county office course, and for the speaker or presenter line, just put in that code CCPCTHUR.
Okay. With that, I think I'll wrap up the evening. Again, I want to thank all of our attendees for joining us tonight and all 3 nights. If you've been with us all 3 nights this week, we really appreciate you taking the time to come and listen to the information that we presented. I also want to thank the Kentucky Agriculture Development Fund for their support of the Kentucky Beef Network and this program that allowed this information to come to you virtually this evening. As a reminder, we will be sending out a recap email later this week that will include the recordings and a copy of all of the slides for your reference. Again, thank you so much for joining us, and we hope you have a great evening.